Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate gibberish, and sometimes just like that fruitcake your aunt gives you every year, it can be a bit dense. Today we're diving into ContextLogic's Form 10K, buckle up because it's a tale of asset sales, strategic pivots, and enough legal jargon to make your head spin. This report is essentially a what's next story for ContextLogic, also known as Wish. After they sold off their main business. Think of it as a corporate makeover episode where they've cleared out the old and are now figuring out what to do with the cash they got from selling their e-commerce platform. They have a pile of money, some tax benefits, and an open road, but they haven't decided which direction to drive in. So this Form 10K is their annual report, basically a deep dive into the past year's performance and a peek at what they're planning. It's like a company's diary, but instead of teenage angst, it's filled with financial figures and risk assessments. For the fiscal year ended December 31, 2024, this means we're looking at their performance from January to December of last year. The commission file number is just a tracking number the SEC uses to keep tabs on them. Think of it as their library card number. They have Class A common stock listed on the NASDAQ under the ticker LOGC. If you're thinking about investing, this is what you'd be buying. The aggregate market value held by non-affiliates is a key number, showing how much the public thinks the company is worth. It was about $149 million in June 2024. Now, pay attention to this, a very important part of all reports, a special note regarding forward-looking statements. It's basically the company saying, hey, we're making our best guesses about the future, but things could change. It's a CYA move, but it's also a good reminder that all investments involve risk. Prior to the asset sale, Wish connected millions of consumers with merchants. Now they are exploring new opportunities for the cash received from selling their main operation. They're sitting on a pile of cash at $162 million in cash equivalents and securities. Their board is looking into strategic opportunities like acquiring assets or a whole new business. Jumping to cybersecurity, they've got systems in place to protect data like firewalls and intrusion detection systems. They have a plan to respond to any attacks and cyber insurance to help cover costs if something goes wrong. The company is not aware of any cybersecurity threats that have materially affected or are reasonably likely to materially affect them. Moving on to legal proceedings. The company notes the lawsuits and investigations in its past. They don't believe that these matters will have a material effect on their business or financial results. However, litigation can be a huge time and resource drain, no matter the outcome. Now we get to the important stuff, risk factors. This section is where ContextLogic lays out all the things that could go wrong, so pay close attention. First, since the asset sale, they have had no real operations and no revenue. This lack of income could really hurt their stock value. There is risk of being seen as an investment company, which could mean all sorts of regulatory trouble, like limits on what they can invest in. Also, the purchaser of the Wish platform didn't take on all the old liabilities. So if one of those old problems comes back to bite them, ContextLogic is still on the hook. They mentioned they have a plan designed to preserve their net operating losses. But even with that plan, there's no guarantee they won't undergo an ownership change that would limit their ability to use those losses. Next, they have nothing to report about unresolved staff comments from the SEC. That's good. Moving on to management's discussion and analysis. This is where management really breaks down the numbers. Total revenue, $43 million. Ouch. That's a big drop from previous years. Ex loss from operations, $79 million. Still losing money even with lower revenues, and net loss was $75 million. Still losing money even with lower revenue. Six-stone Mullins and marketable securities were $149 million. Sales and marketing took a huge hit, down 87%. That's because they're not really selling anything right now. Product development also way down, 83% drop. Not much to develop when you've sold your business. Interest income is down too because they had less cash after the asset sale. Let's look at the actual numbers. Total revenue was $43 million in 2024 compared to 209, about 85% decrease. Q general and administrative expenses are down too, but not as much as revenue. Net cash used in operating activities is a key metric. They burned through $94 million in 2024, though that's less than the $31 million they used in 2023. They go through their accounting policies next. Revenue recognition, important for understanding how they booked sales before the asset sale. Loss contingencies, outlines how they handle potential legal losses, which involves a lot of guessing. Cares the utilization of net operating losses and other tax attributes to offset future taxable income may be subject to limitations under sections 322 and 393 of the Internal Revenue Code, and similar state statutes as a result of ownership changes that could occur in the future. Because they're a smaller reporting company, they are not required to provide this information. Okay, onto the hard numbers, that is if you made it this far. Check out the consolidated balance sheets, specifically accumulated deficit. It's over $3.3 billion, a lot. Take a look at the section about commitments and contingencies. Here they reiterate lawsuits, claims, investigations, and proceedings that arise in the ordinary course of business. Certain of these matters include speculative claims for substantial or indeterminate amounts of damages. And in note 2, there is details on tax benefits, preservation plan, and Series A junior participating. Preferred stock. The company adopted the tax benefits preservation plan in order to protect against a possible limitation on the company's ability to use the company's net operating losses. More about legal proceedings that may result in negative outcomes that could affect the business, results of operation and/or reputation. None, this is not a summary, but the full document. Show what's the big picture here. ContextLogic's Inc. is in a transitional phase. They've sold their main asset and are now looking for a new direction. The key is how wisely they deploy that cash. A good acquisition could turn things around, while a bad one could sink the ship. On the plus side, they have cash and tax benefits, which can offer a solid foundation. The downside is that finding a good acquisition is hard, and there's always the risk of getting bogged down in legal battles. In conclusion, ContextLogic Inc. has some opportunities ahead of it, but also faces some considerable challenges. The key will be whether they can successfully navigate these challenges to build a new future for the company, and whether management and the board of directors make the right strategic moves to leverage this cash. Thanks for decoding with me. If you found this helpful, please give us a like, drop a comment, and subscribe for more deep dives into the world of corporate filings.